I'm going to tell you something that will make most people uncomfortable. But discomfort is often the price of truth. If you're keeping the majority of your wealth in a bank account, waiting for the perfect moment to invest, you think you're being cautious. You think you're being responsible. You think you're playing it safe. You're not. You're choosing a guaranteed loss. And I can prove it with arithmetic so simple a teenager could understand it. Yet somehow very intelligent people miss this constantly. Let me show you the mathematics that nobody wants to face. If inflation runs at 3% annually, and that's the government's polite number, and your savings account pays you 0.5%, you're losing 2.5% of purchasing power every single year. That's not a possibility. That's not a risk. That's a mathematical certainty. Over 10 years, you will lose approximately 25% of what that money can actually buy. Not what the number says on your bank statement, not the nominal amount, but what it can purchase in the real world. And here's what's worse. Most people don't even realize it's happening. The number in their account stays the same or even grows slightly, so they feel secure. They feel safe. They feel like they're doing the right thing. But they're watching the wrong number entirely. You see, humans have a psychological flaw I've observed thousands of times. We measure what's easy to measure instead of what actually matters. We look at nominal dollars because we can see them clearly. We ignore purchasing power because it's abstract. It's like celebrating that your car's fuel gauge is working perfectly while completely ignoring that you're running out of fuel. The measurement device functions fine, but you're still going to end up stranded. Now, I know exactly what you're thinking right now. But Charlie, cash feels safe. I can see the balance. It doesn't fluctuate. It doesn't disappear overnight like stocks can. That feeling? That's your enemy. That feeling is costing you a fortune. We humans suffer from what I call deprival superreaction tendency. We hate losing what we have far more than we enjoy gaining something new. This bias is hardwired into us. It kept our ancestors alive when resources were scarce. But in modern financial markets, this ancient instinct destroys wealth. We're so terrified of a 20% drawdown in stocks, which historically always recovers, that we accept a guaranteed 30% loss over a decade from inflation. We pick certain loss to avoid possible loss. That's not rational. That's just expensive fear. Here's a mental model that has saved me from countless mistakes over 70 years. Always invert. Always think backwards. Instead of asking, what should I buy, ask, what are the ways I'm absolutely certain to lose? When you invert the cash question, the answer becomes blindingly obvious. Holding significant cash in an inflationary environment is voluntarily choosing certain loss over uncertain but historically probable gain. You're picking the guaranteed wrong answer because it feels comfortable in the moment. I learned this principle from studying physics, not economics. In physics, there's a concept called entropy. Everything naturally moves from order to disorder unless you add energy to the system. Cash purchasing power has entropy. It decays naturally, steadily, relentlessly, unless you do something about it. The second mental model you absolutely must understand is compound interest. Einstein supposedly called it the eighth wonder of the world, but he should have mentioned it cuts both ways. When inflation compounds at 3% and your returns are essentially zero, you're experiencing reverse compound interest. You're watching it destroy your wealth in slow motion. It's painless enough year to year that you don't notice the damage, but over decades it's absolutely devastating. Here's what people fundamentally misunderstand. They think volatility equals risk, but volatility is just movement. Real risk is the permanent loss of purchasing power. A diversified stock portfolio might decline 15% in a difficult year. That's volatility. But cash is guaranteed to lose 3% minimum every single year in purchasing power. That's permanent. You never recover it. Warren Buffett and I didn't build Berkshire Hathaway by holding cash. We held productive assets. businesses that generate earnings, that can raise prices, that adapt to changing conditions. When we acquired See's Candies in 1972 for $25 million, people thought we dramatically overpaid. Every traditional metric said we were foolish. But See's had something cash will never have: pricing power. When costs increased, See's could raise prices. When inflation hit, See's adapted. The business was productive. Cash sitting in a bank account has zero pricing power. It has zero ability to adapt. It just sits there, slowly rotting in real terms, waiting for you to make a decision. Let me show you 5 assets that are genuinely safer than cash. Safer in the only way that actually matters: preserving and growing your real purchasing power. And I'll explain the mental models behind each one, so you can think for yourself instead of just memorizing what I say. The first asset is ownership in productive businesses. Most people call these stocks, though I prefer to think of them as what they really are: partial ownership in actual operating companies. Here's the crucial insight that most people miss entirely. A well-managed business with genuine pricing power naturally adjusts for inflation. It's built into the system. Think about Coca-Cola, which Berkshire owns substantial shares in. When inflation increases costs, Coca-Cola doesn't just sit passively losing value like a dollar bill does. The company raises prices, its earnings grow. The value of your ownership grows proportionally. Now, I'm not suggesting you buy just any stock. Most stocks are overpriced most of the time. Most investors are their own worst enemies, trading frantically and destroying returns through fees and terrible timing. But owning carefully selected pieces of exceptional businesses, companies with powerful brands, modest capital requirements, and genuine pricing power, is fundamentally different from holding cash. The mathematics are straightforward. Over the past century, stocks have returned approximately 10% annually on average. Inflation has averaged around 3%. That's a real return of 7%. Cash has returned essentially zero in real terms, often negative. But here's the critical caveat, and this is where most investment advice goes completely wrong. If you don't understand businesses, if you can't read a basic financial statement, if you panic and sell during inevitable downturns, then stocks aren't safer for you personally. You'll make them dangerous through your own behavior. This is about your circle of competence. You must know what you know. More importantly, you must know what you don't know. Never fool yourself about this. The second asset is productive real estate. Notice I said productive, not just any property, but property that generates actual income. A rental property throwing off monthly cash flow is a productive asset, exactly like a business. Real estate has several structural advantages in inflationary environments. Rents typically rise with general price levels. But if you have a mortgage, that debt payment stays fixed. You're effectively repaying it with cheaper and cheaper dollars over time. And the underlying asset often appreciates as construction costs increase. But again, and I cannot emphasize this enough, circle of competence matters enormously. Being a landlord requires work. It demands judgment, maintenance skills, tenant selection abilities. If you don't know what you're doing, you'll buy the wrong property at the wrong price in the wrong location, and you'll wonder why real estate doesn't work. Warren and I have owned substantial real estate through Berkshire over the decades, but always as productive assets. Buildings that businesses operate from. Land that serves genuine economic purposes. Never speculation. Always production based on real cash flows. Here's a simple test for any real estate investment. If the property stopped appreciating in value tomorrow, would you still want to own it based purely on the income it generates? If your honest answer is no, you're not investing. You're speculating. And speculation is just gambling with a more respectable name. The third asset is yourself, your skills, your earning power, your ability to create value in the marketplace. This is the one asset every person possesses, and it's criminally underinvested by most people. Benjamin Franklin understood this centuries ago. He said, and investment in knowledge pays the best interest. Here's why this matters in a discussion about cash safety. If you have $50,000 sitting idle in a bank account and you're early in your career, you might be making a catastrophic mistake. That capital could fund education, professional training, starting a business, investments that could multiply your earning power 5 or 10 times over. I've watched people scrimp and save meticulously, proud of their growing cash balance, while their actual skills become obsolete. They're so focused on protecting what they have that they completely ignore opportunities to become more valuable. That's backwards thinking that guarantees mediocrity. Your total earning power is essentially the present value of all your future earnings, discounted back to today. If you can increase that by even 20% through better skills, you've created far more value than you could generate by investing that same money in any financial asset. And unlike stocks or real estate, your valuable skills cannot be taken away by market crashes or economic downturns. But, and this is absolutely critical, investing in yourself only works if you're brutally honest about what skills actually create real value. Learning obscure, unmarketable skills doesn't count. Learn skills that solve expensive problems for people with money. Skills that are genuinely difficult to replicate. Skills that match real market demand. I spent my entire life deliberately learning across multiple disciplines: law, mathematics, psychology, physics, business operations. Not to impress anyone, not to seem educated, but because solving genuinely complex problems requires tools from many different toolboxes. You cannot build a house with just a hammer. The fourth asset, and this surprises many people, is high-quality bonds in very specific situations. Notice I said high-quality and specific situations, not just any bonds. Certainly not most bonds in today's interest rate environment. Here's the mental model you need. A bond is fundamentally a promise to pay you specific money at specific future dates. The critical question is, what will that money actually be worth when you receive it? If you purchase a 30-year bond yielding 4% and inflation runs at 3%, you're barely maintaining purchasing power, and you've locked up your capital for 3 decades for that privilege. But short-term bonds from genuinely creditworthy issuers can serve a legitimate purpose. They're not there to make you wealthy. They're there to provide optionality, keeping your resources available for when genuine opportunities appear, while earning slightly more than pure cash. Warren frequently talks about Berkshire maintaining cash and cash equivalents, but notice he never keeps much relative to our size, usually just enough to meet known obligations and to seize opportunities when they arise. The bonds are temporary parking spots, not destinations. The mistake people make is treating bonds as safety when they're really just slightly less liquid cash. In genuinely high inflation environments, bonds can be equally dangerous as cash, sometimes more dangerous because they lock you in. Here's the rule. If a bond's yield doesn't meaningfully exceed your realistic expectation for inflation, you're volunteering to lose purchasing power in slow motion. At least with pure cash, you maintain liquidity. The fifth asset is genuinely useful hard assets, things that hold value because they provide real utility to humans, not just because we collectively agree they're valuable. This is completely different from speculation in gold or cryptocurrency, which I'll address momentarily. I'm talking about truly productive assets like farmland that grows food, machinery that generates income, even a reliable vehicle if it directly enables you to earn money. These are things that do something real, that serve actual functions. That would still matter even if the entire financial system had a heart attack. Now let me be extremely clear about gold because many people think it's the obvious answer to inflation. Gold just sits there. It produces nothing. It generates zero earnings. It cannot adapt to changing conditions. You buy it hoping desperately that someone will pay you more for it later. That's not investing by any definition I recognize. That's speculation with an ancient pedigree. Warren jokes that if you took all the gold ever mined in human history and formed it into a single cube, that cube would measure approximately 67 feet on each side. and it would sit there producing absolutely nothing except requiring security guards. Meanwhile, with the same amount of money spent on all that gold, you could purchase thousands of productive businesses generating billions in actual earnings every year. Which sounds more intelligent to you? Hard assets only make rational sense if they're genuinely productive. A farm that actually grows crops people eat, not farmland you're hoping to flip to a greater fool. Tools that enable you to build valuable things, not collectibles you're praying will appreciate. Function over hope, always. The common thread connecting all 5 assets is this: they do something real. Businesses produce goods and services people want. Real estate houses people. Skills enable you to create value. Even bonds, when chosen carefully, provide valuable optionality. They're active, not passive. Cash is purely passive. It sits motionless, slowly deteriorating in real terms, waiting for you to make an actual decision. The question isn't whether cash has any role. Of course it does, for genuine near-term needs and maintaining flexibility for opportunities. The question is whether it deserves to be your primary strategy, your foundation, your safe harbor. And the mathematical answer is absolutely not. Now let's discuss why intelligent people keep making this expensive mistake. Because understanding the psychology is crucial. It's not stupidity. Some extremely intelligent people are terrible with money. It's predictable patterns of human misjudgment that affect everyone. First, there's social proof tendency. Everyone you know keeps substantial money in the bank. Your parents did it. Your colleagues do it. It feels like the responsible adult thing to do, so you do it too, without ever examining whether it actually makes logical sense in your specific situation. But just because everyone does something doesn't make it correct. In Weimar Germany, people who kept their life savings in cash were completely wiped out. The socially normal behavior was also the financially catastrophic behavior. Social proof is a terrible way to make important financial decisions. Second, there's availability bias. The pain of losing money in a dramatic market crash is vivid and memorable. It's on the news constantly. People discuss it. The stories stick in your mind with emotional force. The quiet, invisible erosion of inflation is abstract and boring. So you fear the vivid wrong thing while ignoring the boring, dangerous thing. You can easily see a stock portfolio drop 20% in a terrible year. You cannot easily visualize your purchasing power declining 3% annually for a decade. But the second loss is actually worse. It's 30% and permanent. The first loss is temporary and historically always recovers. Your brain is lying to you about which is more dangerous. Third is deprival superreaction tendency, which I mentioned earlier. We hate losing what we currently have so intensely that we'll do completely irrational things to avoid the feeling of loss. Even if it means accepting certain loss to avoid uncertain loss, even when the math clearly shows we're making ourselves poorer. The solution isn't to somehow eliminate these psychological tendencies. You can't. You're human. You'll always feel them. The solution is to recognize they exist, name them when you catch yourself feeling them, and build systematic processes that protect you from your own predictable psychology. Here's my personal system which you can adapt. I decided long ago, based on rational analysis, not emotion, what percentage of assets should be in different categories. Then I stick to it. I rebalance when necessary. I don't check prices daily. I don't let temporary fear or greed change the fundamental plan. This isn't exciting advice. It's profoundly boring, actually. But boring and rational beats exciting and emotional over any meaningful time period. The tortoise beats the hare not because he's faster, but because he doesn't sprint in random wrong directions. Let me give you a practical framework for thinking about your own situation. I cannot tell you exactly what to do. I don't know your circumstances, knowledge, or temperament. But I can give you the right questions to ask yourself. First question, what is my genuine circle of competence? What do I actually understand deeply? If you understand businesses, perhaps you should hold mostly carefully selected stocks. If you understand real estate thoroughly, perhaps that's your primary focus. If you don't truly understand either, perhaps you focus on low-cost index funds while simultaneously developing your earning skills. Second question, what is my real risk? Not the volatility I see on a screen that makes me emotionally uncomfortable, but the actual chance I won't have sufficient purchasing power to live the life I want. For most people, the true risk is inflation steadily destroying their savings, not temporary market volatility. Third question, what is my honest time horizon? If you genuinely need money in 6 months, fine, keep it in cash. You have no choice. But if you don't need it for 10 years, why would you voluntarily choose an asset guaranteed to lose significant value over that period? Fourth question, what are the second-order consequences? This is where most people stop thinking far too early. They think cash is safe and stop analyzing. But the second-order consequence of safe cash is inadequate retirement, reduced life options, working much longer than you want to. Fifth question, what does inversion tell me? If I hold mostly cash for the next 20 years, what's the highly probable outcome? Can I honestly accept that outcome? If not, what should I change today? These aren't rhetorical questions meant to sound wise. Actually, write down your specific answers. You'll be shocked by how much clarity emerges from simply thinking systematically on paper. Most people never do this basic exercise. They just react emotionally day by day and hope things work out. Now, here's something uncomfortable that needs to be said directly. The reason most people stay financially mediocre isn't lack of opportunity. It's lack of rationality. They make emotional decisions. They follow crowds blindly. They avoid looking at simple mathematics. Then they wonder why their financial situation never meaningfully improves. You cannot think yourself wealthy through positive thinking or affirmations or any of that fashionable nonsense. But you can absolutely think yourself not poor by consistently avoiding stupid mistakes, by understanding compound interest, by not volunteering to lose purchasing power. Warren and I aren't wealthy because we're geniuses. We're wealthy because we're rational, patient, and we don't repeatedly do stupid things. We don't panic and sell during temporary downturns. We don't chase hot trends. We don't confuse frantic activity with actual accomplishment. We just try very hard to not be idiots consistently over many decades. The profound power of this approach is that it's accessible to literally anyone. You don't need a genius-level IQ. You don't need insider information. You don't need luck. You just need to be rational, honest with yourself, and patient. Those three simple things beat brilliance almost every time. Here's a concrete example from our experience. In the late 1990s, everyone was making extraordinary money in technology stocks. The internet bubble was inflating rapidly. People called Warren and me dinosaurs for not participating. They openly laughed at us for holding boring businesses like See's Candies and insurance companies, while they were getting rich in dot-coms. Then the bubble catastrophically popped. People lost entire fortunes overnight. But we didn't lose anything because we weren't playing that particular game. We stuck to what we genuinely understood, bought at sensible prices, and let everyone else chase the excitement. Being rational and patient looked stupid and old-fashioned, right until suddenly it looked brilliant. This exact pattern has repeated countless times throughout history. People get excited, chase returns, panic when things turn, and lose money. Meanwhile, the boring rational approach, buying productive assets at reasonable prices and holding them, just works. It's not exciting, but it works. Now let me address what you're probably thinking. What about emergencies? Don't you need substantial cash for emergencies? Of course you do. I'm not remotely suggesting you invest every single dollar and pray nothing goes wrong. That would be genuinely stupid. The sensible rule is simple. Keep 3 to 6 months of actual expenses in cash or near cash equivalents. That's your emergency fund. That's your sleep well at night money. That's your the car broke down and the roof is leaking money. Keep it completely liquid. Keep it absolutely safe. Don't invest it. Don't touch it except for genuine emergencies. But, and this is crucial, 3 to 6 months of expenses is not 3 to 6 years of income. If you earn $100,000 yearly and actually spend $60,000, your emergency fund should be $15,000 to $30,000, not $300,000. Mathematics matters here. I see people with $200,000 sitting idle in savings accounts for emergencies when they spend $40,000 annually. That's not emergency planning. That's financial malpractice. You have 5 years of expenses sitting completely idle, losing 3% purchasing power annually, when you only need 6 months maximum. The rest of that money should be working for you, in productive businesses that grow, in skills that increase your earning capacity, in anything that preserves and grows real purchasing power. That's not being risky. That's being genuinely responsible. Here's another uncomfortable truth about the financial industry. They frequently give you terrible advice because their incentives don't align with yours at all. They make money from activity, from fees, from products, from you being scared and needing their help constantly. They don't make money from you being rational and patient and not needing them. So they sell complicated products. They imply that navigating markets requires expertise you don't have. They suggest that simply buying great businesses and holding them for decades is somehow irresponsible. It's mostly nonsense. But it's highly profitable nonsense for them. I'm not saying all financial advisors are bad. Some are genuinely excellent and worth every penny. But you must understand what incentives are operating. Are they paid by the hour for straightforward advice, or do they earn commissions on what they sell you? That difference matters enormously. The best financial advice I can give you is completely free. Spend less than you earn. Invest the difference intelligently in productive assets you understand. Be patient. Don't do stupid things. That's it. Everything else is details and optimization around those core principles. But people don't want to hear that. They want a secret. They want the one weird trick. They want to believe there's a complex strategy that will make them wealthy without discipline or patience. There isn't. I'm sorry, but there just isn't. The secret that's not actually secret is that time and rationality beat cleverness and frantic activity. The person who buys great businesses at fair prices and holds them for 40 years will beat the person who trades constantly, chases trends, and pays fees to active managers. History proves this pattern repeatedly. It's not even debatable at this point. Let me give you one final mental model that ties everything together. Opportunity cost. Every dollar you keep in cash earning 0.5% is a dollar not earning 7 or 10% in productive assets. That difference compounds over time into absolutely massive amounts of foregone wealth. If you keep $100,000 in cash for 30 years at 0.5%, you'll have approximately $116,000 in nominal terms. But adjusted for 3% inflation, that's worth only about $48,000 in today's actual purchasing power. You've lost more than half your real wealth by playing it safe. If you'd invested that same $100,000 in a simple index fund averaging 10% returns, you'd have approximately $1.7 million in 30 years. Even after adjusting for inflation, that's about $700,000 in today's purchasing power. The difference between cash and rational investing is literally the difference between poverty and comfort in retirement. I'm not speculating here. This isn't theory. This is precisely what historical data shows repeatedly. The mathematics are completely undeniable. And yet people still make the same expensive mistake because it feels safe in the moment. This is exactly what I mean by avoiding stupidity. You don't need genius-level intelligence to recognize that losing 50% of purchasing power is worse than experiencing temporary volatility. You just need to actually examine the numbers instead of making decisions based purely on feelings. I'm 99 years old. I've spent most of my life watching people make predictable mistakes with money. The same mistakes over and over across generations. Not because people are stupid, but because they're human. The antidote to destructive human nature isn't superhuman willpower or extraordinary intelligence. It's awareness, systematic processes, and patience. Know your biases. Build protective guardrails. Think long-term. Act on logic, not emotion. That's not exciting advice, but it's advice that actually works in the real world. Warren and I built Berkshire Hathaway from a failing textile mill into one of the most valuable companies on earth. We didn't do it by being clever. We did it by being rational, patient, and consistent. We avoided stupid mistakes. We let compound interest do its mathematical work. That's it. The entire secret. You can do exactly the same thing on a smaller scale. You won't build a company worth hundreds of billions, but you can build a comfortable retirement. You can avoid poverty. You can make rational decisions that serve your future self. That's within reach for anyone willing to think clearly and act rationally. The world rewards rationality in the long run, even though it often rewards irrationality in the short run. Be patient, be disciplined, be honest with yourself, and for heaven's sake, don't keep all your money in cash and then wonder why you're not getting ahead financially. The mathematics are simple. The choice is yours.